So speaking of the Fed decision, as I mentioned in my last video, BIS, or Bank for International Settlements, which is an elitist run corporation, just like the IMF, BIS and IMF, like that. BIS warns that the Fed rate hike may unleash the biggest dollar margin call in history. Courtesy of Zero Hedge. Over the past several months, one of the biggest conundrums stumping the financial community has been the record negative swap spread, which we've profiled first in September, and which, as Goldman most recently concluded, quote, has been driven by funding and balance sheet strains, especially since August. Today, in its latest quarterly report, the Bank of International Settlement focused precisely on this latest market dislocation. According to the bank's central bank, or no, not the bank, but the central bank's central bank, which is the BIS, recent quarters have witnessed unusual not spike, but unusual price relationships in fixed income markets. US dollar swap spreads, i.e., the difference between the rate of the fixed leg of a swap and the corresponding treasury yield, have turned negative, moving in the opposite direction from euro swap spreads. Given that counterparties in, there's that word again, derivatives markets, typically banks, of course, are less creditworthy than the government. Swap rates are normally higher than treasury yields because of the additional risk premium. Hence, the negative spreads point to a possible dislocation. There's no possible. Let me fix that. Hence, the negative spreads point to a dislocation coming. One of a set of factors relates to supply and demand conditions in interest rate swap and treasury bond markets. In the swap markets, forces that can compress swap rates include credit enhancements in swaps, hedging demand from corporate bond issuers, and investors seeking to lock in longer durations, like insurers and pension funds, by securing fixed rates via swaps. Let me just ask you something. When you hear all these words, swaps and interest rate swaps and derivatives and credit enhancements and hedging, do you ask yourself, who in the hell made this up? What in the hell is this? We're not a carnival, this is a circus. And the club made up all these terms. And the club also had your Congress pass last year. I also believe, end of November 2014, if I remember correctly, they snuck a little bit of pork into one of those bills they had to pass that allowed banks and their derivatives to be dealt with by the FDIC insurance should a big default type of event happen. It was critical that they got that put on there. Big banks need a bailout. Oh, but they already got one. Big banks need a TARP fund. Oh, they already got that too. Big banks need derivatives that really weren't part of that program. Oh, they got that too. Not derivatives, trillions, excuse me. They got trillions spread amongst themselves and their little subsidiaries and overseas banks. That wasn't even on a vote. It's just the Federal Reserve. Yeah, we'll just take care of that. Oh, that's right. They got that too. And they also need to be bailed out again when those derivatives implode. And they're going to implode, which is why, once again, the government will do stuff in advance. Have stuff taken care of way in advance so that they can deal with something when they need it to be. And this is one of those things they need to be, or needs to be dealt with when it happens. Derivatives failures, we need to back up. I just listened to Congresswoman. Oh God, what's her name? Hang on, it's gonna bother me if I don't look. I'm just gonna tell you now. It's gonna bother me if I don't look. I almost want to say Kathy something. It's not Kathy. Let me check out my, because I'm actually subscribed to her. As much as I don't care for her all the time, sometimes she makes some really good points. Come on, where is her? What's her name? Give me a second. I know it sucks having to stare at my face while I'm staring at the screen. Senator Elizabeth Warren. She was out barking about how these banks got their wishes written by Citigroup. I mentioned it in the video I did when they did it. Citigroup sponsored legislation to include their derivative products. She said that the amount that we're looking at is about $10 trillion. Should they have to be bailed out? How and why are we doing this? And as if something's going to happen or change. Don't hold your breath. So it says in cash markets, in turn, upward pressures on yields. And again, as I read all this, just think of all these ridiculous words, and they've given them these definitions and stuff, and you even a lawyer couldn't figure out all this stuff. The club created all these words and all these products, and they made them so convoluted you don't know what the hell you're talking about. Swap and a swap dealer. Remember that they were the Dodd-Frank Act. Well, the CFTC, we have to redefine what a swap dealer is, because we had swaps before, but is a swap dealer and is swaps by itself or swaps by a swap dealer? We have to redefine swap. What is a swap? What does that actually mean? Remember that one? CFTC a couple years back. So anyway, as I read this, you just think all these stupid words that are literally financial instruments of mass destruction, ultimately. So in cash markets, in turn, upward pressures on yields stemmed from the recent sales of U.S. Treasury securities. I thought it was a bond. Isn't the Treasury bond? Oh, no, it's a security. Oh, sorry. By EME reserve managers, the market impact of these Treasury bonds sales. Oh, I thought they were securities. Now we switched back to bonds. The market impact of these Treasury bond sales may have been amplified by a second set of factors that curb arbitrage and impede smooth market functioning. First, the capacity of dealers' balance sheets to absorb rising inventory may have been overwhelmed by the amount of U.S. Treasury bonds reaching the secondary market in the third quarter. Graph A, which they show on Zero Hedge central panel, causing dealers to bid market yields above the corresponding swap rates. Second, balance sheet constraints may have made it more costly for intermediaries to engage in the speculative arbitrage needed to restore a positive swap spread. Evan, I'm kind of feeling a little hungry right now. A little bread and butter. Do you have any spread? Yeah, any swap spread I can put on my organic swap spread? No? Oh, okay, never mind. Such arbitrage is sensitive to balance sheet costs because it requires leverage with a long treasury position funded in the repo market. And Zero Hedge says, meanwhile, while U.S. swaps spreads hit record negative levels, in Europe the market tensions have been a different nature. 10-year swap spread started to widen in early 2015, around the time when the Swiss National Bank abandoned its currency peg, then increased further over subsequent months. So it says, and with cash markets rapidly depleting of physical inventory as a result of central bank monetization, investors have had to rely on derivatives, is that word again, markets, especially swaptions. Oh, that's not, what was that? They said elf. Oh, that sounds Francisco. That's fun to say. Oh, swaptions. That's fun to say. Let me say. Derivative markets, especially swaptions. Oh, who came up with that word? The club. I could read it differently. And with Mickey Mouse rapidly depleting of physical Donald Duck as a result of Minnie Mouse monetization, their friends have had to rely on the supermarkets, especially swaptions. I mean, it's the same thing. It's all Mickey Mouse. I mean, right? So he says, why is there reduced market depth in cash markets? It's simple, because of central banks' intervention and soaking up of securities. So what the BIS is effectively saying is that as a result of central bank activity, investors have been forced to transact increasingly in the derivatives financial weapons of mass destruction market as a result of which events like the Bund flash smash, which is German bonds, from April led to major market losses for those long Bund duration in either cash or derivatives markets. Since then, volatility in European government bond markets has persisted, culminating with the surge in yields this past Thursday in the aftermath of the ECB's dramatic and extensively discussed here previously disappointment. It's quite a long little thing he's got here, so I'm just going to sum it up with the final little bit of a paragraph. He says he's got a lot of charts and stuff. The title of this is BIS warns the Fed rate hike may unleash the biggest dollar margin call in history from Zero Hedge. He says, as a result of all this, our only question for the upcoming Fed rate hike is how long it will take before the Fed, shortly after increasing rates by a modest 25 basis points, to prove itself, if not so much anyone else, that the U.S. economy is fine, will be forced to maintain trillions of dollars around the globe via swap lines for the second time in a row as the world experiences the biggest USD margin call in history. And I just thought of a song. I could do a parody right now. Remember Blondie? Call me on the line. Swap line. Call me on the swap line. That's the Federal Reserve. You can call me anytime, day or night. Right? Can make a whole parody out of that one. So even the clubs, right? The central bank's central bank is saying, Houston, we got a little problem with our little baby central banks. The same problem places like Zero Hedge, Silver Doctors, Gerald Celente, Peter Schiff, you name it, lots of others have been saying for years. The Federal Reserve's actions are going to cause all of these problems. And they have so far. And when the big one comes, probably in the near future, guess who will have the finger pointing on them? The Federal Reserve. Quick, look surprised.